Hey everyone, hopefully you're having a good day. Again, this is Andy. That's my name, and my channel's Finding Value. I'm always looking for under-investment opportunities, and if that interests you, I share them on the channel. Click subscribe. I'm going through the comment section, reading your guys' comments. Thank you for commenting. You guys have been pretty clean in the comment section. Thank you for commenting, and thank you for being clean. And if you guys see like WhatsApp or whatever, and it's even saying Finding Value Finance, it's not me. I don't have WhatsApp. I don't have any of this garbage. It is someone who is pretending to be me. They put on this stuff in the comment section. Don't click on it. It's not me. Don't, I try to delete them out, but sometimes if you're sleeping, it's hard to do that. So if you see that stuff, no, it's not me. So, says the ratio investing seems to make a lot of sense. What is the rationale to buy the metal physically versus buying some form of derivative that moves the price of the underlying? I know that people hold people like to have their gold at home sometimes, but from your explanation, I prefer that for the investment in precious metals in the U.S. about to increase wealth rather than just preserving it. Could you make a video about that or point me to one that you've already made? So when you buy the metal physically, there's a couple of different reasons. All right. And I'll hit on some. If you own the metal physically, I don't know how they can tax it from you. Like if you own it in somewhere outside of the system, what are they going to do? Come and cut a piece of it off? Like the government doesn't, they don't know that you own it. I don't know how they can tax it. And even if they did know, like, what are they going to do? Come and shave some of your gold off? And if you own it physically, you own the physical metal. If you own it in a Sprott fund, if you own it in some sort of ETF, ETN, whatever you want to name it, you don't own anything. You own a claim on a stake of something, but you can't redeem it unless you own a certain amount of it. You have to own a lot. It's not $5,000 worth. It's like 5,000 ounces worth. And if you don't own 5,000 ounces, you can't redeem it. If you can't redeem it, what exactly do you own? You own nothing. You just own this piece of stake in it. You never have access to the actual physical metal. Now, if you have a problem in your currency system and you own Sprott Fund or something, how do you sell out of it? If you need the physical, if you really need the physical and we have a currency problem, what do you convert into? You can't sell directly into a physical metal, so you're going to have to transfer through a currency. And if you transfer through a currency, I mean, you don't want to do that if you're having hyperinflation problems. You don't want to go back into a currency. So if you own the physical metal, you don't have to transfer anything. You already own it. That's the end all. If you have a shortage in something, a massive shortage in silver, and you're in the Sprott Fund, sure, it'll go up, but you still have to convert back to dollars. Now, there's positives here. If you sell your metals and you were to report the tax, you're going to pay a higher tax on selling metals than you would selling a long-term hold in a stock. If you sell the long-term hold in a stock, well, then you pay 15%. On physical metals, if you sell it and you pay taxes on it, that is considered a collectible, and I think it's 28%. But I'm sure if you guys own the physical, you could sell it to other individuals with cash, and it's up to you on what you do. So it's up to the person to pay the tax. So remember, you're out of the system. You are out of the system. There's no traceability of this. There's no anything. It is up to you as an individual to pay taxes. Now, I find it a little bit ludicrous to be paying taxes on gold and silver as it is constitutional money. If it's constitutional money, why would you pay tax on it? That doesn't make any sense to me. But in the tax, it's considered a collectible. And if you make gains on it, you pay tax. Now, here's the thing that I don't like about the system in general, about dollars and inflation. This is what I absolutely detest. Like, I do not like this. They inflate the currency supply. You have to speculate. They force you into taking risk. You take the risk, you make the money. And let's say you make 10%, but let's say inflation was 10%. You made no money, but you still have to pay taxes on the 10% gain. So you're losing money and you're paying taxes. I hate that. I absolutely hate that. So you not only do you have to be an exceptional investor to beat inflation, because the S&P 500 is roughly the rate of inflation. It doesn't really go up. It's just inflating. Inflation's probably 9-10%. The average of the S&P is about 9-10% on a long-term basis. So that's going to force you into ratio investing. You're going to have to identify undervalued assets. You're going to have to buy the undervalued asset, and then you're going to have to wait for those ratios and money flows to reverse those things around. That's the only way you can make purchasing power gains. You can't do it by just sticking it in the S&P 500. Now, back in the day when we had a gold standard and our money was backed by gold, constitutional stuff, the stuff that actually keeps, it's basically forced discipline on the system. You could go into stocks and make money because they returned over the rate of the money creation. So they were giving you a positive purchasing power gains throughout a very long time in history. Ever since the Federal Reserve took over, it's been this boom bust cycle, and it's been absolutely horrible for investors because you have to get the cycle right. If you don't get the cycle right, you're getting thrown all over the place. You're making money, getting killed, making money, getting killed from these boom busts. The boom busts are tied to real estate, just to let you know. There was someone I wanted to comment over here. See, here's this WhatsApp thing right here. That right there, that's not me. This guy, I think, probably tried to impersonate me. But there was somebody who, oh God, I hate these things, guys. I hate these people, and they usually come with crypto because they always, oh, crypto is the best thing ever. It's like, yeah, okay, whatever. But someone had responded. Oh, where is it? God, this stupid WhatsApp stuff. Where is it? It was a pretty long. God, there's a lot of these WhatsApp stuff. I'm gonna have to delete some stuff out. I can't find it right now. But basically, he was talking about the price. Oh, maybe it was down here. This was the guy Alessandro. Let me go all the way back up, come back down. It was pretty recent. Okay, here we go. He says that he thinks gold's going to be revalued to $250,000 an ounce and silver to $35,000, not only because of hyperinflation, but because out of the 300 million Americans, maybe 5 million have gold and silver at maximum. During the Great Depression, every American had gold and silver. Well, gold and silver was our money. It was spread out across the nation. So that is why everything would drastically deflate against gold and silver, like Weimar Germany. So he thinks gold's going to go to 250,000, silver to 35,000. That is a very high number. I was looking at the price of gold and gold miners in the Great Depression. So it says gold was $20 an ounce, and one gold miner was worth $35 an ounce, and the other was $6. The first became worth $60, and the other one jumped to $35 during the Great Depression. Today, almost $2,000 is worth 1 ounce of gold, and the most expensive gold miner is worth $125. They should really be worth $12.50 according to the pre-Great Depression ratio. When hyperinflation begins and the gold standard returns with gold being revalued to $250,000, holding stock in gold miners will be like holding shares in a central bank. $125 could turn into $500,000 if the mining stock price doubles gold's price. I don't know if we're going to have a hyperinflation. I can tell you through history, the price of any commodity, what it does is it bounces between a demand shortage where it kind of goes all the way up, and we'll call it moves kind of vertically or moves pretty good when there's a supply shortage. And then what happens is it peters out, the supply comes online. It may take 4, 5, 6, 7, 8, 9, 10 years, depending on the commodity and how fast they can grow this stuff or get it out of the earth. And then we go into a supply-demand glut. And then what it does is it falls all the way back down to the higher cost, high cost producers below their cost curve. And it bounces between those two things. The demand, where the demand basically gets thwarted or slowed down, and then supply comes online. So that's the peak, and then the bottom is where the cost curves are at. And usually what happens is you see the ratios will tell you where the top is at, because that's where things like where they slow down, is where when the ratio gets to a certain spot, people are like, okay, in relationship to other assets, we're good. I don't want to put any more money in this, or they start to substitute things with other things. And that's what we have, are those ratios to guide us the valuation. Now, if in this world that you're describing, where gold's $250,000 an ounce, everything else is going to go up massively. So the commodity sector, I think commodities would actually maybe even go up more than gold, because they're going to have more value to humans than gold would. Gold would have the value of preserving wealth and purchasing things. But some commodities, if they have an incredible value to humans, like, for instance, water, or some other commodity that is needed like food, they may go up more. I don't know. So, and another one, they said, where do I find cost curves? What I do is I can type in like uranium cost curves. I mean, I literally just search in Google and then I click images. That's so, and then you'll see some. So I'll shrink myself way up. I typed in uranium cost curves, and then I clicked images. And what you're going to find are these are the cost curves of uranium. This is the cost curve. Kazatomprom's way down here. They're the lowest. And then you can see all these other ones. It doesn't have the names of the producers, but you can see where the costs are at. You can see that the highest cost curves go all the way up to $80 or $90 for this particular cost curve. And you can look at a whole bunch. Here's ones where it goes up to about $65. And they give you the names of where they're at in some of the projects or mine deposits or mines. And you can see all these different ones. Arrow, average first 5 years, really low. Arrow is Next Gen Energies. I actually own that company quite a bit in it. This is a Namibia mine way up here. This looks like $20, and then it goes way up. So obviously, they're not all going to be the same, but these are all cost curves for uranium. And you can just type it in, and you can see different cost curves. And that's what I use for the most part. And companies, sometimes in their presentations, they put in cost curves as well. And you can see what the costs are for certain deposits and mines. What's important is the price bounces between it'll drop below the high cost producers. Supply gets cut back drastically. In uranium, I don't think there's any supply really getting made right now or produced. Comes back up and goes to some level where the ratio is going to tell us what's overvalued in history. The ratios tell us where that demand supply in history kind of slows down. The demand supply and where this thing starts to equalize at a very high price. So the ratios guide us and tell us value. Cost curves gives you another indication where your ratio goes into a buy zone. You start looking at the cost curves, and if your price goes below the upper cost producers and even the mid tiers, because right now we're probably below the mid tier producers in uranium. That is like it's a bottom. You're basically scraping the bottom there. Now, if you're doing this with physical metals like platinum or silver, that's when you load up. I mean, there's no risk in buying the physical metal, the output of these companies. The output, there's zero risk. You want to buy it as cheap as you possibly can. So if the ratios say, go ahead and buy this, you buy the living heck out of it. Because it's literally just a waiting game after that. You just continue to cost average in, you pile in when you're below the cost curves and the ratio's cheap. I don't know if the ratio can be expensive and be below a cost curve. I don't think I've ever seen that. So the ratio will be cheap if you're below the cost curves in relationship to other metals. And keep in mind, the cost curves are going to go up in an inflationary environment. So we could see this move up. Technology's trying to bring them down. Inflation's trying to bring them back up. So we have this battle of technology getting more efficient at extracting metals from the ground, which lowers the costs. And then you've got the big inflationary pressures of the dollar declining that are pushing the cost curves back up. Now, at some point, you're going to get to a ore grade, which is very low. It's happening in copper right now, where energy input costs go up exponentially. And I think that's going to affect the cost curve in a negative way. It's going to go way higher. So if we are moving towards lower and lower ore grades, and we hit a certain point where we're using such low of ore grades, the costs are going to go way higher because it's going to exponentially use more energy. So they were, I'm just going to make this up. They're using 500,000 barrels to extract copper. Next would be 1.5 million. It's a big move higher in input costs. So they're going to have to move way more tonnage. They're going to have to extract way less out of it. And it's an uphill battle in terms of energy use. Now, technology is not going to save all this. What I think is going to happen is technology is going to extract things even faster. We're going to consume things even faster, and eventually we're going to hit a brick wall. It's going to be like, we can't produce anymore at near rates that we can. So they're going to deplete our high ore grade mines very quickly. And then we're going to turn to very low ore grades with exponential energy, more use. And we're going to have to find solutions. Maybe we use renewable energy and we just pile in the energy to extract this stuff. I highly doubt we're going to go to some other planet or mine an asteroid or direct an asteroid at Earth and end humans. That would be a really fun one there. But I highly doubt we're going to mine on asteroids, just because when you start moving things in space or in the air, like airplanes, weight is, you do not want weight. And mining is all weight. So that is something that I think prices would have to be astronomically higher. And if that happens and you've got physical metals, you got what everybody wants. That is, and if you guys get the most valuable metals are the ones that provide the most utility to society. Anything in this world, if you provide the most utility to society, you're gonna make the money. That's where the money's at. So silver, platinum, those are two that I really like. Copper, I invest in the companies, and I hold physically platinum, gold, and silver. And as these things get harder and harder to extract, they're going to get more rare. As they get more rare, prices go way up. And there could be a potential where a currency fails because really what backs a currency is energy. And if your energy source gets more scarce, and I'm not saying this is going to happen, but if it gets more scarce, everything's predicated off of growth. If that growth doesn't exist in the future, if everyone gets scared and they say the energy is not as plentiful as we think it's going to be, stock starts to crash because they're priced on future earnings. We are expanding the money supply, which means you need future growth in order to pay back the money supply. And if you don't have the future growth, if you don't have that energy, everything starts to implode. So that's another viewpoint, just to get that out there. If you guys like this content, give me a thumbs up. I appreciate you guys listening. This is Finding Value.